So since Brian has the mic, he's going to answer the first question for us. And we have three general areas that we're going to focus on for our questions. Technology, staffing, and then just some general business. And if we have time at the end, we'll also invite questions from the audience. So, Brian, let's start off with a staffing question from you. How has remote work impacted your organization?
So remote work, it's been really good and really bad. Not really bad, but it's kind of been a culture shift a little bit with remote work. But the benefit that we've had with remote work is we've been able to obtain a lot of specialized roles that we probably wouldn't have considered as much in previous years. So like we hired a reinsurance expert. He's based out of California, LA area. Really great. So we probably, I don't know if we would have considered that as much pre-COVID, but we've got a reinsurance expert. We've hired some actuarial analysts, not actuarial analysts, but actual actuaries to help our chief actuary that are based out of California. We've got people, I think we have people in 19 different states that we've employed. We have offices in 5 or 6 places, but a lot of people in a lot of different areas that have been really beneficial to getting the expertise we need. Because, Utah, not a ton of commercial insurance carriers in Utah, so not a lot of people that we can go to find expertise. So we've been using that as we've been growing and expanding in different lines of commercial insurance. So that's been helpful for us to have a bigger pool to pull from.
Awesome. And Daren, for Bear River, how's that impacted you for remote work?
So, as mentioned, I've been at Bear River for almost 5 years. When I first started there, 100% were Utah employees. Now we've got employees in, the most has been 5 states. We're down to about 3 states, but similar to what Brian mentioned, the reason why we've expanded and used remote employees is we're looking for a specific skill set that we had difficulty finding here in Utah, and so we expanded geographically for our search, and that's the reason we filled it. I think the key with remote is sometimes you don't get the collaboration that you do when you're in office. Sometimes we've required some of these employees to fly in and if they're working on specific projects. But then the other thing is the key is making sure you monitor productivity, right? And so outside of that, I just wanted to mention one thing, and I'm not going to mention any names or stuff, but part of monitoring productivity, we had one particular employee that we had to terminate employment for because they had purchased a software package that would allow them to log onto the system and do certain work. And so it looked as if they were working 8 hours a day or longer, but in reality, they're producing about 2 hours worth of work. And so when that was discovered, obviously that relationship was terminated. But that's the key is how do you hire people for certain skill sets when you need to expand further out than your current geographical location, and then how do you monitor that?
Yeah, and I think it's hard when that trust is broken by those employees and you realize, I guess I do need to check up on certain things or have questions with certain people. Byron, anything to add for you?
I think you guys covered it well. It is a mixed bag for sure. It gives us, and I'm sure everyone here has had that same experience, right? It gives you the opportunity to broaden your reach of employees. It comes with challenges. We've had similar challenges as far as having them be fully engaged in their work. So that's the challenge that comes with it. But I think overall, the opportunity of being able to hire remote employees outweighs that. And so I think it's a positive overall for sure. That's been the case for us.
Now we'll do a quick follow-up question with this. So for the people that are near your office, are you fully in office? Are you hybrid? Or do you allow some employees that are close to your office to be remote?
Sure. So we do it by department. We let the head of the department make that call on what's best for their department. And so it's a complete mixed bag where some of our employees are there. I was going to say 7 days a week, 5 days a week, and full time. Not very many, but anyway. Some are those that are local that work remotely. Right now we just require them to come in 1 day a week, and then one Friday a month we have everyone in. So that's and probably at least quarterly, I'm asking, are we sure we shouldn't be requiring them to come in 2 or 3 days a week? Because that's the trend that we see everybody doing. And at least so far, they feel like, look, they're just as productive at home. We're making sure they're getting everything done. And how do we justify it? We're getting enough collaboration the way we are. And then we have some fully remote employees that we, like Brian said, we try to make sure we're flying them in at least quarterly or so to have that interaction time in person. But other than that, it's a mixed bag.
Same question.
So we are doing a hybrid. So some employees that have been 5 days remote are now required to come in 2 or 3 days a week. And it's been a little bit difficult for us as employees that have been hired during COVID or after, right? And during that hiring process, they were told that they could have 100% remote. So depending on their productivity and then also whether or not we can replace that skill set or not, then we've made it's one by one decision whether or not we require them to come in.
Okay.
So I think if you're within 50 miles to one of our offices, we're having everybody come in 3 days a week. If you're farther than that, you're kind of hired as a remote worker, and we're not requiring you to do that. So it's 3 days a week minimum. I've been in 5 days a week for most of the time, and I'm just super unproductive at home. I get too many projects I work on. So I've been 5 days. A lot of our finance department were 4 days at least in the office. We brought in everybody, like the whole company, like 550 people, at least those who could, most of them, this May for a big company-wide event to try and kind of strengthen culture, get people to see faces. So that was really good. So we found, the more you can collaborate in person, the better you get to know people. So we're big on having people together. So that's kind of what we're doing.
Okay. We'll shift to a technology question, and we'll start with Daren. Now remind me, Bear River's been in business since 1908, is that right? Or earlier? 1909. I was a year off. Dang it. Okay. So obviously through that long history, you've experienced some technical and technology updates. So how hard has it been to upgrade or phase out some of those legacy systems to catch up and be prepared for the future?
So just to be clear, I haven't been there since 1907. So right now, I kind of feel picked on right now, and the reason is, and our auditors know this, we're into 7 years of an implementation project that originally started as a 3-year project. It's basically went out and bought a suite that, is our claims administration, policy administration, and also billing. But the key really is, I think, setting up a good project manager on both sides of that relationship, and then monitoring the progress and testing, the progress of the coding or the implementation as much as you can. Now, the question is whether or not it's easy to get rid of the legacy systems. I've worked for 3 different insurance companies and went through implementations with all 3, and it's difficult to get rid of it. Yeah. Right now, what we've decided to do with Bear River is, because we were going to do a big bang, pick a day, and then shut off the legacy systems and switch over to the new system. Testing's proved that we probably won't be doing that. So we're going to do a phase-in approach and pick blocks of business by agencies. One at a time, switch an agency over, and then if the first 2 or 3 go pretty well, then we'll switch everybody else over. And so that's what we've decided to do.
Okay. Brian or Byron, do you have anything to add on that?
I'll just add real quick. We're just in a process of one at a time trying to assess and then convert when it makes sense. our different systems. We haven't tried to tackle the policy admin system yet. We're saving that for last. So it's working okay, but we know it's not nearly as efficient as at least we hope an alternative will be. But so we're kind of biting at the apple a little more slowly. But Brian?
So I've been at WCF for 11 years now, and it was shortly after I got there they finished their we got rid of our final green screen. The finance piece, the GL piece, was the last piece to be switched over. They had done claims and underwriting, moved that away from the AS 400 or whatever those old systems were. So that's been great to be away from those. Yeah, it's a lot of work. I was at Sentinel before, and we had an old green screen. It was terrible, and we were starting to go there when I left, starting to go away from that. Yeah, just a lot of work.
Okay. And I think one of the hard things is I think there's a lot of options and people say it'll solve all your problems. They sell it to you, and then like Daren said, it takes 7 years plus instead of the 3-year implementation process. So I wanted to ask, are there any good options in the market that you've seen, or has it traditionally been, something that you've produced internally, coded internally, that you built from the ground up?
So at WCF, our biggest department of employees is our IT department. We're almost an IT company more than an insurance company, but we've built internally our Xanthos system that we have our claim system, our underwriting policy admin system, and our finance system on the Xanthos product, and it's been really good. But we're a 100-year-old company, and we've done workers' compensation insurance for 99 years, not really, but we just the last 5 years have started going in other commercial lines of insurance, so commercial auto, liability, umbrella. We've got those admin systems, like the policy admin in Xanthos, and we've been starting to build our commercial claim systems and trying to get it in our Xanthos system. But we decided it's probably a good idea for us to look externally, and so we're actually looking right now at Duck Creek or Guidewire, one of those big industry systems. So we've historically done all of our development internally, and it's for the most part been really good. But we'll see. We're looking right now.
Okay.
Pick Daren's brain after this meeting.
So I mentioned that I've been with 3 different insurance companies. At all 3, they've gone through some software implementation. And I was at workers' comp when they were working with switching to another system, and they decided to do it internally. So I'd just say that one thing that each company should do is do a due diligence within your own company to see if you have the talent within, or if you can hire the talent within. Because a lot of times you buy these canned systems out there, and I've been in the industry long enough that you used to go buy a software package and it did 98% or 95% of what you needed, and you configured a little bit of it and customize to your product lines. But now it seems like you get these shell software packages out there that you do the majority of the configuration, and that's where we're at. And it becomes very costly, and so I mentioned it takes longer and costs more. I'd just say rule of thumb for us has been 3 times as long and 3 times more costly. So, but if you do it right, you monitor it correctly, I think you can stay, within the budget that you set. And then again, hopefully you make the right decision whether you do it internally or externally.
Yeah.
All right, I don't know if we all have to answer every question, but but we're very similar. Our system is all built in house, and so we're maybe late to the game of really evaluating outside third party services to replace those, and so that's the process we're doing. But historically, it's and currently all of our claims and such are our legacy system that we're doing.
Okay.
I'd say don't listen to the salespeople, though, because they tell you it does everything you want.
For a third of the cost. And they keep making commissions the more you pay. So something that Daren mentioned is, do you have the right people internally? And I think for Byron, what staffing resource is scarcest right now for you in your company?
Our challenge, we've had, interestingly, given the audience here, right? Our challenge has been, we've had challenges with accounting, statutory accounting specifically, like looking for that experience of who can we hire, and that's where, again, being able to hire remotely helps with that, because it's such a niche skill set or experience. So that was a challenge for us when we were needing to hire that. So that's what comes to mind, is that when you're looking for that experience, specific experience, right? And statutory accounting is definitely one of those, right? What about you guys?
So ours has been IT, and every year we get around to our annual operating plan or planning for the next year, and it seems like IT always comes in and they want to overhire and fill seats that they're not quite sure if they're going to utilize. But the key is if they see individuals out there that have a skill set that we need, they do kind of overhire for that, because, through attrition, sometimes it's hard to, go out and replace that. And so that's where our heartburn from the majority of where our hiring hiccups have come is through the IT department.
I kind of mentioned it a little bit earlier, but like our biggest one has been specialized underwriting and product analysis. So developing these new products, getting people who've actually done it is hard in Utah. So that's where the remote work has been really helpful for us, is being able to search nationally and find people who have that expertise actuarially and underwriting wise. So.
And with the baby boomer generation starting to retire and all their expertise and knowledge, is that causing some of the shortages, or are you able to kind of plan for that and have succession planning in place in order to prevent, brain drain?
Yeah. Well, kind of not related to that other problem, but for brain drain and like other specialized areas, we've started doing mentorship programs, like an official mentoring program at WCF. So I think there was like 15 people in the program last year. They would be assigned a specific mentor, and you would work with that mentor and have meetings two times a month maybe, and get information from them. We've also started an internship program. So, you all know this probably. Insurance isn't really like who of us decided we wanted to go into insurance when we were in college? None of us probably. So we've got an internship program. We worked with UVU and kind of risk management, setting up a program down at UVU that we've given donations to. So trying to build up the insurance industry locally, that's been helpful, something we've been trying to do.
So we've learned the difficult path of replacing people that have been here long term, right? By this last 2 or 3 years, we've had 4 or 5 people leave that had 30 to 40 years of insurance experience with Bear River. The way we've been able to overcome it is we've hired them on as consultants and then helped transfer some of that knowledge. So I think going forward, the smart thing to do is the mentorship, and then documentation is key, and then have a succession planning process in place so that you don't end up paying twice somebody's salary, later on for them to come back.
For them to work in retirement and have a pretty good gig.
Yeah, I agree with all those. That's been our experience as well. So we try to have kind of from the top down, make sure our board of directors is aware of our, there's 2 phases, or 2 types of succession planning is your planned succession, then you have replacement planning if it's an unplanned replacement, right? And so we try to make sure we have that formally documented and updated at least annually. And so if there's leadership challenges there, at least our board of directors knows about that and is aware of contingency plans that way. And it's developing. It'll be interesting. Like our management team, we're all pretty similar ages in our 50s, and so it's like, okay, let's make sure that we're planning ahead for that next generation. We've already kind of gone through one and looking for that, and documentation I think is key. We call them bus books, where if you get hit by a bus, we have your all your key things that you do, and the challenge is keeping it updated. Things change so much that's our challenge, but we try. So
And we'll stick with you, Byron, but thank you for your comments on that. And with the challenge of the baby boomers retiring, having scarcity of resources, there's also another challenge with PE firms. So as a smaller insurance carriers competing with, new PE-backed entities who are earning higher investment yields, what are some of the things you can do in order to compete in kind of that market?
Yeah, so that's a lot of the focus or my area of responsibility is on the investing part of the company, and so I attend a lot of conferences that are related to that, and that's a huge topic is how do carriers compete, and so I'm sure you guys see a lot of that. There's a lot of change in focus or even acceptance, I should say, in alternative investments to private credit or commercial real estate debt, things like that that carriers are recognizing, look, we just have to start branching out away from corporate bonds and getting more of our investments invested in higher yielding investments. And it'll be really interesting to see where this goes, right? I think some private equity backed carriers are very responsible, and they're in the industry for the long run, and they just have expertise and the experience to invest in more profitable investments. I think some are very reckless and irresponsible, perhaps. That at least they're taking more risk than maybe the industry is used to, and you as Warren Buffett says, you learn who's swimming naked when the tide goes out, right? And the tide hasn't really gone out yet for almost 20 years, and so we'll see if it does, and hopefully, the worst case scenario is that you get some of these very large carriers that are very aggressive in their investments, and you have reinsurance failures and things like that ripple down into a lot of areas, but hopefully that doesn't happen, right? Hopefully that's, for the most part, it's just time for the industry to be more diverse in how we invest, and we still do it smartly, I hope. Can I answer your question?
Yeah. And like Byron said, you don't have to answer every question if you don't want to. So you'd like to comment though?
Yeah.
Just one thing, my experience with being PE backed is, so I was at Equitable when the private equity group came in and ended up purchasing the company. But one is, most private equity firms are looking short term. I don't know if this is your experience, but their decisions and perspectives are more short term than long term, and then they want everything done yesterday. And in insurance, when you come through some years where you have ups and downs, and you'll have a year that's profitable and then a couple of years that aren't profitable, private equity firms immediately want to figure out how to solve the unprofitable years, and sometimes that means getting a little bit more aggressive on your investments or changing up who your reinsurers are. But if you make the decisions all on the short-term perspective, it's going to come back to bite you. Mm-hmm.
So I have a couple thoughts kind of related. Hopefully that's okay. So
Yep.
The private equity side that we are kind of more concerned about is on the agency side. So agency consolidation. We see a lot of private equity firms coming in and buying up small local agencies, consolidating them into these big, agency conglomerates that are owned by private equity. That is really, we're worried about it limiting, who they send their business to. And so they get all these agencies bought up, and then they send all their business to this subset of insurance companies, and it's hard to get business otherwise. So that's one of our biggest concerns, honestly, is these private equity groups buying up all these agencies. So the other side, so I worked, like I mentioned, I worked at Sentinel for a little while, and the risky investment side, you're trying to chase yield, right? So I was there during kind of a perfect storm. We had an excessive growth factor. They went from like $30 million in written premium historically forever, and expanded into the annuities, and so they all of a sudden they had $300 million of premium, but most of it, like 90% of it, was ceded to big reinsurers. But we still got hit in our RBC with excessive growth, so we had that. Plus, we were having to get a yield, so we were looking more alternative, like commercial backed investments, not your corporate bond. And so we had not only the RBC hit from the excessive growth, but also from the higher risk investments. So that just destroyed our RBC. So that's one risk in trying to go with those PE-backed insurance companies, is chasing yield. Just got to be careful of everything that affects your RBC, because there's so many things that can factor in and shoot you in the foot. You've got to be careful with the state starts asking a lot of questions then.
Yeah, thank you. So with all these challenges, is AI going to help at all, or is it still a dream?
I don't think AI is a magic pill for insurance, but I think it's really like our chief information officer, two CIOs.
Right.
He says AI is not going to take your job, but somebody who knows how to use AI is going to take your job, right? So we're trying to get everybody to use AI to make them more efficient. What we've been using it for, what I've been personally using it for, is helping draft presentations and helping me brainstorm ideas. It's really great for helping come up with ideas and just learning how to do it. But our chief actuary, he has built he's built a whole interactive AI agent between our reserving database and reserve reporting and analysis on it. So there's really cool things that can be done with it. So maybe it will take our jobs, but it's a really, really useful tool we found, and it's helped us efficiency wise and personally and kind of departmentally. There's certain areas that we're trying to get, like for processing, straight through easier underwriting, running that through AI analysis. So there's a lot of good things that are coming from it.
So with respect to AI, I think companies need to embrace AI. Right now I feel, and this is just my own experience, and a little bit the way our chief information officer is talking, as well as our chief technology officer, we're starting to invest in some AI. The goal is getting people experience, because we've already got employees that have some expertise, but having them experienced in AI where they can guide AI to become a useful tool for us rather than being replaced by AI, because right now AI is still in the early stages, right? And there's a lot of errors that come out, but where we're utilizing it is some refining our coding and streamlining some of the coding that's tedious, and takes a lot of time, and then helping improve some of the coding. But one thing we've realized, if you guide it well, and even if you're using it just for presentations, with the amount of data that it has access to, it will produce an output that's a lot better than you can produce yourself. So there's a lot of value. Everybody's going to end up using it. Question is, how much time and resources and finances do you invest in that now to hit the ground running a year from now or 2 years from now?
Yeah, I think it's fascinating. It absolutely is changing work in a huge way, and will just do so more and more with time. One of the best uses so far that our company has had is we do commercial real estate lending. That's a lot of what we do, and our underwriting team has developed using ChatGPT to develop a model that they can drop into it any version of like operating statements, rent rolls, financials, things like that we get from a borrower that could be in PDF or spreadsheet or Word or whatever format they're in, and they've trained it what to look for and how to then take all that into a standardized format that we can then use, and it does it in seconds, what would take them normally hours to do. And it's still, they're still developing and testing and things like that to make sure that it's consistent in what it's doing, but it's super powerful of what efficiency it can do for them. And I love ChatGPT. If you have the paid version of it, right, you can have these projects that it'll retain all the memory, everything you put in there, in that context within that project, it retains it. So any questions, follow-up questions you have, you're not starting from scratch, a new query, a new chat or whatever, right? And you can actually collaborate with team members so you can share these projects. And it's great from a legal document standpoint. I can put in contracts and I can just drop it in and say, summarize this for me, or what are our party's responsibilities, or what's changed between these versions. Tell me if there's any changes, differences that have been made. So things like that just save a lot of time, and it's super powerful. So I'm excited about it.
Thank you. So we've talked a lot about the struggles on the business side, but we also know that consumers have been facing quite a bit of challenges, with COVID, high inflationary environments. So what kind of behavior shifts have you seen from consumers the past few years with COVID and then shifting to a higher inflation environment?
Do you guys? I'll just say on the annuity side of the business, which is our primary product line, those have certainly come with higher interest rates. Those have come more in vogue, right? Those are more interesting now that they're paying higher interest rates. But from a consumer standpoint, you guys can speak more to that, I'm sure.
So P&C, we're home and auto, which is mandated, right? You're forced to have auto insurance, and then if you have a loan on your home, you have to have homeowners insurance. And so there's no change really from what we've seen with our block of business on whether or not they have the coverage. What we've noticed, though, and we made some business changes because of it, policyholders were coming to us and asking if they could increase their deductibles to save on the increases in premium. And so we started increasing deductibles, and then we said, well, maybe we go out and do it across the board and mitigate some of the need to have premium rate increases every year. And so that's what we did a year and a half ago. And so the key, I think, with insurance, everybody knows inflation's driven up our necessary expenditures, right? And the key is how can they keep it flat or mitigate the increase. You've got to make changes to what the policies provide or the coverage in order to stay within your budget.
Yeah, the main thing I could think of as well is kind of the loss-based products like higher deductible. We've had more people inquire for large deductible workers' comp policies than in the last few years than historically.
In an effort to maintain their premiums.
Yeah, trying to keep premium costs down.
Usually you get your good policyholders who are, for us, are responsible drivers and homeowners, and those that are a little bit more aggressive drivers or less responsible don't want the deductible increase because they know, there's a high probability they're going to get in an accident or file a homeowner's claim. But so to some regard, you get some anti-selection there, but the key is getting a good balance to where you can meet both their needs and retain policyholders so you don't lose policyholders. And
with those deductibles, are you having to, double the deductible in order to keep premiums pretty steady, or is it a marginal increase? So ours, we doubled. So Double.
So if you had, I don't know how many of you are Bear River policyholders, but if you had a $500 auto deductible, and that we went up to $1,000. So the minimum you can have with Bear River is $1,000. But that was to keep us from doing rate increases of 20 to 30%, and because the last 3 years, with not only inflation but our claim frequency had increased, especially with the younger generation, right? Because everybody's on cell phones and easily distracted. But so we went out, we doubled the auto, and then we had a ton of policyholders that were at $1,000 deductible on their home, and we took that to $2,500. But we thought we'd see a huge number of policyholders drop off, but at the time it was very small. So the increase in deductible really didn't change our policy count.
Okay. You mentioned loss events. I just wanted to talk a little bit about that. Are you seeing, higher frequency, lower frequency, and just higher costs per loss event, or what's some of the trends that you're seeing with those?
So the answer is yes. So for us, we were seeing frequency and severity both increasing at the same time, which is a double whammy, right? And what increased the frequency was distracted driving, and then the other thing is speed. And I hate to throw it into age demographics, but we have the data. The industry has the data, and the younger generation, they like to drive faster, and then they're more distracted. And so if we had the true data, I think all states would outlaw the use of cell phones in automobiles. You have people that get in accidents that lie, that say that they weren't using their cell phone, but we've had individuals hit a car that's parked off the side of the street. Nobody else is on that street. They're on it themselves, and they claim they weren't on their phone, but they'll hit a parked car going 45 miles an hour and claim that it was due to a sneeze. And so we've had a couple of things like that, or they're looking at a cat or whatever. But
I will say sneezes during high speeds is very scary.
Very dangerous, yeah. Anyway, so for us, we were seeing an increase in frequency and severity. When we increased the deductible, frequency went down, right, because a lot of your lower claims dropped off the books. And so our frequency has dropped, but severity just continues to climb. And in auto, why is it? It's because speed causes greater accidents, and then distracted driving creates greater accidents, and then more costly accidents. And the other thing is because of inflation, the replacement parts have gotten so costly that our total auto, when we go in and we total the automobile, the count on total auto claims has gone up quite a bit. And it's cheaper to replace a car than it is to get it fixed. And so
isn't part of that, though, the way they make cars these days, it seems like they're just, every part is so expensive. They're all customized and electronics and all
everything's
that stuff.
computer, even windshields over the years, right, have become
Yeah.
a lot more costly. And so car parts have become so expensive that you get in an accident nowadays, there's a high probability that your car's going to be totaled. So I don't know how you track this, but my guess is those who are taking the totaled automobiles and turning around and fixing them and selling them, if they can do it with older parts, they're making a killing.
Mm-hmm.
Have you seen the same things with workers' comp claims, Brad?
We've actually seen a steady decline in frequency over the last few years, but our severity, like this year, our severity it's a really concerning year for us. We're monitoring. We've had a lot of really big $1 million plus claims this year. Some TBIs, a couple TBIs, some electrocutions. So we're not sure if it's just a fluke, but we're monitoring this year, especially really closely, just for a huge severity uptick. Frequency's been going down, and it's kind of resulted in Utah. I mean, in the work comp market, especially in Utah, we've had rate decreases for the last 10 years, just going down steadily, going down each year, by 5% down, not 9% decreases. So we've been having to adjust, tiers, what tier we place people in to keep pace with premium.
Okay. Well, we have a few minutes left. We wanted to open it up for questions from the audience.
I was curious about lifetime. Are you going to say anything?
Well, I can speak more to our life business is small enough that it's really, we're not a good measurement, but I attend a lot of conferences, and so the industry certainly, especially smaller, like final expense business especially, they were hit quite hard with COVID, and it's still in recovery mode is what I understand there. The other thing, as you're making me think of that, it's interesting industry-wide at least, there's a lot of carriers that have old blocks of annuities that are on these, lower interest rate, minimum guaranteed policies that when interest rates went up back in 2022, I think is when they rose interest rates a bunch. The subsequent years, they've had a lot of those policies that they've had the the profitable situation of having pretty low cost annuities sitting there for a long time. Finally, a lot of those leaving and going to the higher interest rate annuities, and that creates, they're investing in longer term investments typically, and so that creates a strain on their investments to have a unusually high level of withdrawals of annuities because they're finally getting higher yields, and so that's been a challenge for the annuity industry, for some carriers anyway. Yeah. What else?
So there was a big spike in the mortality during COVID.
There was, yeah, especially so the demographics, right? So final expense is a demographic. Generally, these are lower face value life insurance policies sold more to low income homes and or families, and I think that's probably the part of the the population that was hit the hardest with mortality from that standpoint, and those, generally speaking, those products have marginal profitability anyway. They're hard to be profitable because there's large lapse rates and things like that. Persistency is difficult. So when you're having a lot more lapses than claims, and then all of a sudden you're having claims, now you're paying out those full benefits greater than the reserves, right? And yet you still had to pay out the commissions and things like that, and you didn't have the assets there long enough to pay you back. So that's been the challenge there.
Any other questions from the audience? Go
This
ahead.
might be kind of on the spot. I know we don't have a health carrier on the panel, but we do have some health carriers in the room. I don't know if there's any trends you guys are seeing that you would want to chime in on, either on consumer behavior, premiums, like that kind of thing. I know you probably don't want to.
Allison's asking the non-panelists to answer.
As you guys were talking about that healthcare stuff that we all generally deal with, I thought if there wasn't, but no pressure. Dave or Steve, go for it.
I'd say for us, we've had high claims. It's just been a rough couple of years overall. The cost of healthcare and keeping premiums competitive with it.
So I can say something I've seen from an employer's perspective. So we just went through renewing our annual benefits, right? Employee benefits. And one thing that I noticed jumped quite a bit from prior years was health claim or mental health claims. So you look back 3 years ago, the amount of claims related to mental health was down to like number 20 on a list of 30 or 40 different items for health insurance. To last year, it was number 3, and I wouldn't be surprised if it jumps to number 1 the way it's going.
Wow.
Actually, specialty drugs is like a killer. So expensive.
Margot has a question, I guess.
I have a question. Have you noticed a change in the way people are purchasing your products? I mean, is one of the things you struggle with getting a product to policyholders, or do you just work, like, are you working directly with consumers more now that they're shopping on the internet? Are they coming to your website? Do you have an app? Like, how are people purchasing your product, and is it harder to get it to people, the people who need it?
So who are you asking?
Oh.
All right, so since I have the mic, I'll answer first. So for us, one, we're very dedicated to our agency task force, so we don't do any direct sell. So if somebody calls into the office, we're going to direct them to an agent. And so they have to talk to a Bear River insurance agent. One thing we're finding out, though, is the younger generation does not like to talk to people. They would rather just purchase it online, and so we might need to make a change there. But even employees, the younger generation of employees that we're hiring don't like to talk to people. But then you had another question, or how are we delivering it to them? So we've gone to a lot of our delivery stuff is digital now. So really the agent's job, and if I were to start my career over again, I'd probably be an insurance agent in the P&C industry, because It's their products that are mandated. It's really it's a buy. You're making a buy, right? Or closing a buy rather than a sell. You don't have to really sell a lot on these products, but I think there's a huge need out there for agents to pay attention to the needs of their policyholders. I think that's lacking, and then adjust their coverages and the products that they've sold to them according to their needs.
For us, kind of agency related as well. I mentioned earlier, our biggest concern is our agency consolidation. So we're trying to make sure that we maintain good relationships with our agents and offer, value added where we can, like with our safety services for avoiding injuries and accidents in the workplace, trying to provide benefits there, just being responsive to agents, just maintaining that good relationship with agents is our biggest concern.
Yeah, similar thing. We see, so our industry, it's interesting to hear other companies. I'll share with you what I hear a lot from other company leaders, that many of them have gone through this process of going from all paper apps to all digital apps or some hybrid between the two. And it's fun to hear the experience of the agents, like those agents that just don't want to go digital. They're comfortable with the way they've been doing it, and some of the companies have struggled to do we require it or not, but they're so much more efficient in processing those digital applications, electronic applications. And so most of them have gone to requiring electronic applications, and you just take it off the table if it's required or not. We're still kind of in the camp that we accept either. We have digital versions or paper versions, and we have different agents that do both. We do a small enough volume that it hasn't been a big of enough deal for us to require digital only. Yeah, so I don't know if that answered your question or not completely. I forgot. It was a multi-part question. But.
Very important.
So you don't even remember. All right.
Well, let's give a round of applause to our panelists. And feel free to ask more complicated questions as they get back to their seats.
They'll all be around, so if there's something you don't want to ask the group, find them. We'll take another 10-minute break and be back at 11 for our last presentation.